Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. All right, welcome back to another episode where Paul and I teach you how to control your capital.
Yeah, or somebody else will.
That's right. What's going on, Paul?
Not much. We picked up our new car yesterday, and it's sprinkling all day today, so it's been crappy out.
So that's a free car wash. Go out, throw some Dawn like dish soap on it,
Don't use
and just let
that takes off all your wax. Oh wait, it has to have wax on it to take off.
I don't
first.
wax cars. I send them through the car wash, automatic. The brushes actually touch the car. I know that's a sin for you.
It is.
Yeah,
Yeah, we hand wash.
yeah.
But hey, you could pay people. You get all those kids now. Pay those kids to watch that thing.
Are you kidding me? Like they pick up a handful of gravel and rub it on the car. Like I don't need that. No way.
Yeah.
No, I mean I got two kids that have their own cars, so now they're washing their cars, and it's which is good. I'm glad they care. Yeah.
Yep. So it's good. Pride of ownership is important.
Yeah, big time. Well, hey, happy Labor Day, everybody. I know when you're listening to this or when this podcast drops, it's going to be Labor Day.
Yeah,
So-
workers united.
Workers of the world unite, the most Marxist holiday on the calendar.
All that labor that, well, what about the capital that paid for the labor? Does that matter at all? I don't know.
Somebody was controlling their own capital and was able to put that to work and create those jobs. Right?
Yep.
Hey.
And speaking of capital, I was just flipping through Instagram, and an Ayn Rand video came up, and I need to send it to you because it was 1957. She had some super intelligent things to say about economics and other things and government control over capital. So
Yeah, it's amazing the insight some people had. The 50s was 70, 80 years ago. Now you're talking 70 years ago.
yeah, pushing. Yeah.
Yeah. A couple like Napoleon Hill, not just his famous Think and Grow Rich, which, hey, if the producer's listening, Jack, go ahead and throw that link for that book in the show notes, please. Think and Grow Rich. He also had another one. Oh, man, I will have to think of that and put that in the show notes too. But another book that was just amazing for his time. In fact, it wasn't even published until after he was dead, because I think his family was scared for him to publish it because of the pushback he would get from people high up.
Sure.
But I read that one. It was phenomenal. Napoleon Hill. Search his books. They're amazing. And the insight he had 70 years ago was pretty incredible. I mean, he was talking about how smoking cigarettes is a stupid thing to do, and it's really bad for you, even though all the doctors at the time were saying menthols are great for you. They actually improve your health, and buy this brand. Yeah. So now they have a different message.
Yeah.
Yeah. But yeah. So anyway, Labor Day, the official end of summer, kids going back to school. My kids, I had 4 of them start today, and 4 of them start the day after Labor Day, or 3 of them. The other 3 start the day after Labor Day. So
Yep. My kids went back last week.
yeah.
Yep.
That's it's nice. I had to wake up. So my son wanted my youngest buzzed his hair this summer. Actually, my younger 2 boys, and he wanted a fresh buzz right before school today. So I took him out to the garage and buzzed his.
So like an even Steven?
Oh, yeah. And he's got the perfect round little head. It's like so perfectly shaped. Like, man, I've shaved my
I couldn't
dome
pull it off.
a couple times for deployments and basic training and all that. And it was just because it was easy. But yeah, that's not for me.
No.
Yeah. Well, anyway, man, let's see. We got our first football game tonight.
Okay.
So, yeah.
Under the lights?
Oh, yeah. 8 p.m. under the lights. So, yeah.
Sweet.
Looking forward to that.
And it's
But,
hot up there, you said, too.
it's not bad now. It's like 80. So it's actually
Okay.
going to be in the 70s tonight. It's going to be beautiful.
Nice.
Yeah.
Beautiful.
Yeah. Be real nice. So, yeah. All right. Hey, I thought we'd start with, let me tell a little story, personal story about, the question that comes up a lot of, hey, when do I know it's time for me to add another policy, or as we like to say, another branch to your family bank? When do you add another one? So I'm going to give my story on why I'm about to add 4 more policies and maybe a 5th here pretty soon. So I, blended families last year. I got 3 kids. Hannah's got 4. My kids all have policies. As soon as we got married, got Hannah a policy, a big policy for her. So she's good. And then I got myself another one, and just, a series of them. Well, and I've had a lot of policy loans out because you and I put that capital to work, right? It does fine just sitting in our policies. And in fact, we put it to work while it's still in our policies. So we like to put it to work because now it's going to work in 2 places at the exact same time. So I've had a lot of loans out, and this year I've been able to repay all of my loans, pay all the premiums, fund new policy premiums. So everything's paid up. I don't have any more room to put capital inside my policies. And that's a bad thing. Like, that to me is like, I should have seen that coming, a couple of months ago and planned ahead. Right. So now the next question is, well, I've got capital residing and accumulating in somebody else's bank, which is what we preach against all the time. So now it's time to find somewhere for that capital to reside. And in my case, I have 4 perfect insurable interests. So 4 kids, now stepkids, that they all need a policy. So that's where I'm going next. Get those going.
Yep. Best time to buy a policy is when you're young and healthy.
Oh, yeah. Yep.
And
super easy
underwriting. Although I just had an easy underwriting. It was like 3 days and the guy was 61 years old. But anyway, it was unheard of.
Wow, that is.
So yeah, great time to expand the system to accommodate your income now.
Yeah.
Right. Page 48 in Nelson's book, by the way, folks. Expanding the system to accommodate all income. It's great little couple pages there. But no, I like it. Something to be said about juvenile policies too, Dave, is a lot of people don't realize this because they're always like, we've got this question that comes up sometimes. Should I get policies on my children first?
Mm-hmm.
And of course, my answer is always, well, no. Are you insurable, Dad or Mom? Well, yes, we are. We're healthy and haven't had any health issues or whatever. I was like, well, no. The first set of policies should be on generation 1. In some cases, we're talking to people whose parents, we might be talking to some folks in their 20s or 30s, whose parents are only in their 50s. If they're insurable, I would make the argument that we should look at them.
Interesting.
As well.
Yeah. Sorry, folks, we had a little technical glitch there. So, Paul, go back to when you're talking about making the case for a 20-year-old buying a policy on their 50-year-old parent.
Oh, that's where it fell off. Wow.
Yeah.
Okay, I was talking to nothing because I noticed you froze, and I was like, "Uh-oh, I'm just gonna keep talking."
Because I was so intrigued by what you were saying, you just stopped me still.
Yeah, so I know I've had clients in the past or in their late 20s, early 30s that have, introduced IBC to their folks. And of course, Dad is a traditional, max my 401k or IRA and put money in the stock market, all that stuff. And that's all fine. And mildly interested about the dividend banking concept and dividend paying whole life insurance. Well, not knowing that, hey, let's sequence the money into policy on you, Dad, first, because you're most likely going to, graduate before I do because you're 30 years older than I am.
Yeah.
That is the most likely scenario. So I've had clients try to do that. Like, hey, Paul, I've tried to convince my parents. They're just, you know, they're too set in their ways or whatever. But at least they made the effort, and they were smart enough to recognize that's going to benefit me. That's going to benefit my brother, my sister, the grandchildren. And I don't know if I caught this before, but juvenile policies are great, but they're at like a tobacco rate. They're kind of like a standard tobacco rating until the child turns 18. Then you get them reassessed, you know, preferred, no tobacco, you know, whatever it is, super preferred, whatever.
Yep.
And that's just the way it is. So I always tell people, like, get generation 1 insured first. Then if that's the grandparents, great. If that's you, the parent, first generation, great. You should be insured to the fullest extent first, and then you worry about the children.
Right.
Anyway.
Yeah.
Which is what you've done in your household. It's what I've done in my house.
Yeah. There's an order that makes sense because, you know, if you just think of it, you know, it's a morbid thought, but you just think of it in terms of finances and financial impact. How much impact is there financially if, God forbid, a child passes versus a parent, right? It's greater if a parent goes, so they need to be covered. So we don't always have to put the banking piece of this puzzle at the forefront, right? In fact, I think you and I are both on the same page. Like, we can't neglect the death benefit part of whole life insurance. That's what it is, right? It's life insurance.
It's very important.
It's very important. Frankly, the most important, because it's the one thing that makes everything else work.
That's right.
So you got to focus on that and say, yeah, I get it. Oh, hey, my wife is 5 years younger. She's healthier. Maybe we should get the policy on her. She's a stay-at-home mom. Nope, man, if you're the breadwinner, even if you're older, doesn't matter. Like, we can design the policy. I mean, you could design her policy to be less efficient than yours. It doesn't really matter. There's different ways to design it. But yeah, you know, you got to think of the financial impact of the loss of that person's income.
Yep. I always basically tell people, and this is well before I even put an illustration in front of folks. I do that later in the process, as you do, I think, is that you're splitting hairs. One, you're splitting hairs over something you haven't even looked at yet.
Right.
You're thinking in your mind because you've read some stuff on Investopedia or some other online, you know, generic, you know, content creators that have these experts that write these articles and stuff. But you're splitting hairs over almost nothing.
Right.
You're replacing somebody's income with life insurance. That's what it's there for. So if someone doesn't have an income, yes, you're going to feel that loss if all of a sudden you have to take on as the dad all the childcare things and the cooking and the whatever your roles are, right? You're going to feel that. Oh,
yep.
Daycare. I have to pay for that now because I don't have, you know, a housewife that's doing those things.
Right.
Or even a house husband in some cases.
Yeah.
But yes, the breadwinner first and foremost.
Yeah. So you have conversations with people sometimes, and they're very into the details, policy design, numbers, and details. So it's really important to, like, zoom back out. Let's just boil this down. What is this about? This is about controlling your capital, so that somebody else can't.
That's right.
So let's start there. You know, that's the 30,000 foot view. You got to control your capital. Now let's figure out what's the best way to control your capital. If you do this right, you're going to end up with more death benefit than you know what to do.
You can get past the underwriters.
Right. Yeah. As much as you can get past the underwriters. So yeah, let's keep it simple, not over complicate something that shouldn't be overcomplicated. Which, going back to when is it time to add more policies? I realize I've got everything paid back. I can handle the premiums. Time to get more policies. My capital needs to go somewhere, and those policies are great. In the future, I can make the children the owners of those policies, you know, when they're old enough to use it responsibly, appropriately. And guess what? If I just change the ownership of that to them, look at all that cash value they have access to.
That's right.
Is that going to show up as income for them?
Nope.
No. So what a great way to transfer some wealth to your kids, to your offspring, to your beneficiary, to anybody that you have an insurable interest in.
Yep. Without any IRS involvement or any tax or Big Brother looking over your shoulder. None of that stuff. So just to summarize, Dave, so you've got all your current premiums that you're responsible for paying, base premium and PUA premium spoken for the year.
Correct.
You've got all policy loans on all the policies that you own repaid.
Yep.
And now you have cash stacking up in somebody else's bank, either your business checking or your personal checking or whatever, wherever it's at. It's somewhere, folks, right? It could be a CD, it could be somewhere else, but it's in someone else's banking institution that I don't control, that I don't get the dividend from. So now Dave is saying, hey, it's time to expand the system to accommodate my increased income.
Yeah, it's a no-brainer. I mean, there's only one place I want to put this extra capital, and that's inside more policies. So now here's what because I've taken so many loans out to put towards other opportunities that have come my way, those opportunities, that money is still with those opportunities. Those haven't matured yet, and that money hasn't come back to me. So what quote unquote problem am I facing in the future?
A windfall.
A windfall. So that money is going to come back to me because I put my money in very safe places, very safe scenarios where it earns a consistent return, and I'm very, very confident it's coming back to me.
Right.
So when that comes back to me, that's a windfall. So right. I need to prepare for that because I'm not going to want to just go stick that into the local bank account here, which probably exceed the FDIC insured amount, because that's really worth a lot anyway if a bank fails. Yeah. But so how do I prepare? How would you prepare for a windfall, Paul? Like if you're not ready to fund a policy now, but hey, I'm going to sell a property, or I'm a real estate investor, I'm going to sell one property every year for the next 5-10 years. How are you preparing? What's a quick and easy way to prepare for that windfall?
So I think a great way to do it, and I think we've mentioned it over the past year and a half we've been on the air here, is I always like to have, and I'm guilty of not having one in place right now, but I'm about to, a massive amount of convertible term policies. Let's say it's a 10-year, because I think in my mind in 10 years I'll be able to convert all of this to a whole life policy or policies. So I like to have that in my hip pocket, convertible term, getting as close to as my anticipated human life value as I can get. So as income rises, our human life value goes up. Therefore, to an underwriter's eyes, I'm worth more because I've made more money, let's say. So I like to have that convertible term in place so that even if something happens to me in the next decade, health-wise, I can snap my finger. Really, it's not snapping a finger, but it's a few pieces of paper. It's very easy. You've done it. I've done it a few times.
Well, frankly, the insurer doesn't have to do anything. They tell
right.
you and me, hey, I want to convert
That's
this,
right.
and we do it.
Very, very simple, very easy.
Yeah.
Process, and it's seamless. But that's a great way to get after not only the human life value, but being prepared for a windfall that is coming ultimately.
Yeah, absolutely. If you want to dig more into convertible term and kind of the ins and outs of that, go to episode 18. And we got a whole episode on, how does convertible term fit into this IBC strategy? The IBC is a concept, but this whole thing is a strategy of how to control your capital. And that's a perfect way to do it. So that's absolutely, I've already got a big convertible term. So I've already prepared for that windfall whenever it may come. And that'll be pretty cool because I'll just be able to pull from that insurance, start a new whole life policy, and put that money in there right away, get it going. But until then, it's time to open some more and, look for other opportunities. It feels really good to have all those loans repaid.
It does. No, it does. I tell you, the older I get, I think maybe, I don't know what it is, but I like having the knowledge that I can get to a large amount of capital. And when I say large, folks, I mean relative to my income, right? Your number might be bigger than mine or smaller than mine or the same, whatever. But it's relative. For me, it's a large amount of money that I have earmarked for opportunities. But really, my next opportunity, and we've talked about it, is to build my forever home the way I want, without compromise. Because every time I've compromised on something, like saving $1,500 on a car, not getting that option, and then realizing that $1,500 over 6 years is nothing.
Yeah.
And every time I look at it, I'm like, damn it.
Yeah.
I'm such a cheapskate, right? So stupid. I don't want to do that. So anyway, yes, it feels great consolidating the capital. We've got some, I think, and I'm not an economist, that we've got some things on the horizon. There's some stuff economically going on in China that I've been kind of keeping my eye on, that I don't like. We have uncertainty in Eastern Europe with there's just
next year's an election year.
We have an election coming up. We've had a lot of money printing over the last few years. It's just ridiculous. The cost of real estate's ridiculous. The price of fuel is still ridiculous. So there's just a lot of uncertainty. So I'm in that kind of consolidation mode, because if you're ready for opportunity, you can make money in any market, good or bad.
Yeah.
And I firmly believe that. But so anyway, yes. But bottom line, yes, feels great. Love repaying policy loans. Just,
the only bummer about it is now I have nowhere for my extra capital to go. I've got nowhere for it to reside until I start new policies. So I got to get that up and going, up and running, and then pay those premiums. And once those are paid, then I'm back to the same problem of where do I put this capital? So it really does. I mean, expanding the system to accommodate all income. That's a really difficult thing to think at the beginning.
It's nice to know that living the IBC life, that we know what to do, and I'm hoping we're putting it in simple enough terms for people that, hey, bottom line is, when you have money stacking up in somebody else's bank and you anticipate having that level of income year after year after year stacking up in somebody else's bank, it might be time to consider opening up another policy, especially if you're not fully insured, or your wife's not fully insured, or your husband, or you don't have policies on the children yet, or whatever. So that's kind of what we're getting at, and what Dave's about to do, due to this change in his circumstances on his personal life, and so that's what it's all about. Page 48, just to reiterate.
Yep. So it really shifts your way of thinking. Go ahead. You have another thought.
I know people are going to go to page 48, which is great, and they're going to say, so I can can I design a policy so I can put my entire paycheck into it and then take a policy loan and pay my monthly expenses?
Yeah.
Okay. That's not what Nelson is really saying. Although I will say this, because in there he says, shouldn't premiums and income match? Well, the way I've kind of heard it put is, well, is a dividend, paid into the PUA, is that premium? Yeah.
Yeah.
Can these dividends get quite large, many times the current premium over time? Yeah, they sure can. We could have $100,000 premium if your premium is big enough, or $100,000 dividend.
Yeah.
Now, anyway, but the goal is just to pay high premium relative to your income. The devil's in the details, but you cannot put your entire $10,000 a month paycheck into a policy every month as premium and then take policy loans that live off. If there's people out there doing that, that's not the intent.
No, and I think it complicates things.
And you're not going to get that past the underwriter.
You're not. So keep it simple.
Unless your agent is lying.
Unless your agent is lying. Exactly.
Yeah. Right.
So keep it simple. Start where you're at. I had that conversation with somebody today. In fact, another couple I was talking to, they've actually got more kids than me. They've got 9 kids.
Whoa.
Yeah. And they were talking about, should we wait a little while, and get our health in a better situation? My first question was, are you insured right now? Do you have life insurance? They said, yep, we have term insurance, like $1 million each. So, okay, then yeah, there's a case to be made that, you've got a little time on your hands because you have insurance. If you had no insurance, I'd say, no, I can't recommend that. My professional opinion is absolutely not. You can't wait.
Yeah, we don't know until we throw you into the underwriting process. Companies look at different things. Some companies are more forgivable for height, weight, BMI type calculations. And there's things that we can put in the underwriting notes that, if you're a bodybuilder and you're just, you're a heavy dude who lifts heavy things and your BMI is 30 or something, but you're fit, and I could see that, I know that you're fit, then we're going to put some notes in there. But
yeah. So, but my advice to them was, you may not be able to start where you want to start right now, but start where you're at.
Right. That's right.
Start where you're at, and you'll find quickly how to expand the system. You'll find reasons. I mean, they've got 11 insurable interests in their family right now. So there's no shortage of ability to add another branch to their bank, their family
That's
bank.
Right. Yep.
Except that, shoot, if they got to insure all 9 kids at the same time, that's a...
No, they can just be very, very small policies. I think we can open up, typical IBC policy is generally going to be, you want it to be about $100,000 of underwriting, roughly. But if it can't be that high, it'll eventually reach that amount, obviously, over time. But
yeah,
$1,000 a year is I think the smallest that they'll do on most of the policies that are structured for this.
Yeah. Yeah. Well, so I mean, to sum it up, there's some very obvious times in life when it's time to add more policies.
Yep.
And when you're stacking capital in somebody else's bank, it's time.
It's time. And if I said $1,000 a month, I meant $1,000 a year. I wasn't sure if I said month or year, but it's $1,000 a year.
Oh, is it minimum premium?
Yeah,
that you've seen.
Premium.
Yeah,
Mm-hmm.
That's not much, right? On a monthly basis.
No, it's 83.33.
Yeah, you can make that happen,
mm-hmm.
right? So, stack capital in your own bank, in your own banking system, and prepare for that windfall. I've talked to so many people lately who are sitting on cash from selling a house, and maybe they've already got a second house,
mm-hmm.
So they don't they don't know what to do with that except stick it in a brokerage account, and do whatever they can do with that, or there's a great place to catch a windfall and get all of that into a policy, or maybe we should talk about the PDF writer in another episode, but a way to fund a policy for the next 10 years, say, without you having to pay out of pocket a dime, because you have that windfall that you can put to work right away.
Yeah. And it gives you more bang for your premium buck.
It really does, big time. So yeah, let's reserve that for another episode, because I think that's a great one that I've been encountering quite a bit recently, actually. That could be a good fit for a lot of people. So stay tuned for that message coming up. But hey, everybody, enjoy your Labor Day and your day off. And hey, hopefully the fall turns out well for everybody. I'm hoping for a real Indian summer here. A nice long fall, right? Where, but what we get is like 100 degrees and then it's snowing.
Yeah, winter is coming.
Winter is coming, as they say. Indeed, it is. So, well, all right, everybody. Hey, thanks for listening. And we haven't said this in quite some time, but hey, leave us a review. We've got like 97 reviews. I want to hit 100. So if there's 3 of you out there listening, maybe you can be the 100th review we get. That'd be pretty awesome. So please get in there this is Apple, on Apple iTunes. So podcast, we got like 97, I think. So let's hit 100. So do us a favor if you like what you hear. So even if you don't do a 1-star, but leave a comment. Don't be a coward.
That makes it average, gives us some legitimacy. Like, oh, not everyone likes it.
Right. Yeah. I mean, we have 1 star. So, I mean, another one wouldn't kill us. But yeah, leave a review. Hey, and until next time, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.